Hello, everyone. My name is Brad Renard. I'm Chief Investment Officer of Monthly Cash Through Options, and thank you very much for joining me on this biweekly market update. The date, November 1st, 2018. And on the bottom right, I show four of our strategies: small cap momentum, contrarian fund, sector rotation, and directional alpha. They're up 23%, 9%, 12%, and 5% respectively year to date. And those returns are as of October 31st, 2018. So if you have any interest in learning more about those strategies, please visit our website at monthlycashthroughoptions.com. Okay, let's look at the charts. It's been a pretty ugly market for the last 2 weeks. We just had a major market correction. This is the SPX, S&P 500 index. It has 500 large cap stocks in it. And we can see that it pulled back really hard and it found support around 2640, and we had a higher high. So I have an upward sloping line here. So overall, the upward sloping channel looks good. It's just the sell-off was really bad, and that caused a lot of technical damage. And as of November 1st, we're getting a bounce. Most likely we have seen a bottom, but can't quite trust this market yet until we get back over the 200-day line. And I'll talk a little more about that. Here are the industrials, the Dow, 30 stocks. And this one looks a little better. We're actually back over the 200-day line already. So this is actually good news. So this probably will drag the rest of the indices higher now since the Dow is back over the 200-day line. Upward sloping line, that's a higher low. That's actually good news. And we had a higher high. So we still have an upward sloping trend line, but the sell-off was pretty bad, and it caused a lot of technical damage. NASDAQ Composite, kind of the same looking chart, higher low. It's still below the 200-day line. We still need for this to get back over the 200-day line. NASDAQ Composite has about 2,500 stocks in it. So here's the MDY. This represents mid caps, has 400 stocks in it. And the mid caps and the small caps usually get hit harder. And you can see that this one did. It fell really hard and found support at its lowest low back in February of 2018. And that's expected for the mid caps and the small caps. It's still way below the 200-day line, and it's going to take a while to get back over the 200-day line. Small caps, Russell 2000, this one has 2,000 small cap stocks in it. And this one looks like this mid caps, pretty beat up. It found support at its lowest low in February of 2018, and it's still way below the 200-day line. So sell-offs happen. No fun when they hit. In general, they're healthy for the market, but the economy is still strong. So jobs growth, fiscal stimulus, that's the tax cuts, earnings growth, consumer spending. We'll talk more about those and we'll show some charts. So stocks went up for 2 years after the Trump win. We got an incremental $8 of earnings from the corporate tax cut and deregulation and infrastructure spending. That all just drove the market higher. So stocks are currently fairly priced at 15.8 times forward S&P 500 earnings of $173. That represents all 500 companies within the S&P 500 index. And you add up each of the company's earnings per share, and we're sitting at $173. And that represents looking forward 4 quarters. So it is a prediction. It's not real. It's what the analysts are predicting that what will be generated over the next 4 quarters for the S&P 500 companies. A lot of technical damage was done in the intermediate term. And the SPX probably is going to hit resistance at 28.75 now through December or January. So this sell-off was pretty bad, and it sends a message that stocks are done going straight up. So concerns that eventually triggered the sell-off are the following. Rising interest rates. The yield on the 10-year Treasury broke up through major resistance. China's economy is slowing and is exacerbated by the tariffs. Rising input costs for U.S. companies from the tariffs, from the trade war. So that's causing inflation, or it's causing higher expenses, input costs for companies. And if they can't pass those costs on to the consumer, then it's going to hit their margins and ultimately hit their stock price. Fed raising short-term rates too fast, which will slow economic growth. That is a concern. A concern that the 9-year bull market is coming to an end. I don't quite agree with that yet, but that was the concern. And flattening yield curve of U.S. Treasuries, and that predicts a recession. Usually looks out about 12 months to 18 months when you start having a flattening yield curve. Concern that tax cuts will be losing momentum by early 2019. U.S. deficit nearing $1 trillion annually from the tax cuts. We have a strong dollar, and that's putting stress on emerging markets, which also impact global markets. Corporate debt markets were sending signals of stress. Small caps were rolling over. And then finally, in the big one, the SPX finally broke below 28.75, and that was a technical trigger, and then that caused a lot of selling. So let's look at some of the culprits that caused the correction. Here is TNX. This is the 10-year Treasury. We can see that the interest rate broke up through 3.11%, spiked, and that spooked the market. Higher interest rates usually will be a drag on the overall economy and on stocks. Here is the yield curve, or this represents the difference between the 2-year bond and the 10-year Treasury. And that gives you an idea of how much difference between those two are, and that gives you an idea of the yield, of the slope of the yield curve. And we can see that there's only 28 basis points between the 2-year note and the 10-year note, telling you that the yield curve is flattening. And that's usually a precursor to a recession, sometimes. And but it looks out way in the future, usually 12 months, up to even looking out even farther, 15 months, 18 months. Here's HYG representing high yield bonds. When this starts selling off, that means the interest rates on the high yield bonds are climbing. And this is what high yield bonds represent: debt that companies sell when they're raising money. And that just shows that there's stress in the high yield corporate debt market, and that usually will impact stocks eventually because it represents stress in the system. Here's UUP. This represents the US dollar, and you can see it's been climbing. And this impacts, it's okay to have a strong dollar, you just don't want it too strong because it eventually will weigh on large cap stocks that sell internationally. Also, it weighs on emerging markets, especially a lot of emerging markets that raised a lot of money and issued debt in dollars because it makes their expense costs higher when they're paying their interest payments on their debt. So this impacts global markets when we have a strong dollar. FXI, this is China. We can see it's been rolling over, and a lot of that's been caused by the trade wars, or some of it, plus China has been slowing. And then they're the second largest economy in the world, and this does impact the US. Here's EWG, Germany, and when it's rolling over, that does not help us. Germany is a good proxy for most of Europe, and when it's rolling over, it can wash ashore into the US markets. So we have to be very careful and watch Germany, France, mostly Germany, but we usually watch a few of the other large economies in Europe too. Then finally, SPX broke below 28.75. So this was a technical break. This was the high back in February or January. Anyone in the business knew that we needed to watch this level. It's just you don't know how bad it's going to be. You just don't know really what's going to happen and how much it's going to sell off, and really is going to turn into a full-blown correction. And this one did. It got pretty bad. So once that broke, we were down really fast. You really had no time at all. And then it found some support at the 200-day line, and then it took out a lower low. So pretty ugly sell-off. Here's what happened with volatility. Volatility popped. And what's interesting is it didn't go that high compared to the volatility pop back in February. When we had the correction of February, volatility touched 50. And here it really only touched about just under 30. And we're already down to under 20 or near 20. So very interesting. I just didn't see a lot of the fear that I thought I would have seen with this sell-off. So maybe it tells me that it won't be that bad, or we'll bounce back a little more quickly as the markets rebound. Have we found a bottom? Well, let's just look at some charts. So looking at the SPX, it tells me maybe, not 100% sure. I see a lot of technical damage. I see the index still below the 200-day line. And my belief on this is I need the SPX to get back over the 200-day line around 27.60 and really preferably get over this level, 27.90, before I would feel comfortable with the market. However, on the Dow Jones, I feel better because this is already back over the 200-day line and back over this 25,332. So that looks pretty good. So that just tells me that we probably did find the bottom, and because the Dow is already over its 200-day line, it's probably going to start dragging the other indices higher. Here's NASDAQ McClellan oscillator. So there's 2,500 stocks in this index, and it's a pretty fast oscillator based on advancers and decliners. It's pretty fast moving. It works well, and it tells me that money is flowing in. There's many more advancers versus decliners at the moment, but I usually want a moving average to go above it. So this moving average filters this, and it's a 35-day EMA. And once this gets back over this line, it'll tell me that we're probably out of the woods, but not yet. Here is the McClellan oscillator on the OEX. So this is the largest of the big cap stocks. Same thing. They all pretty much look the same. They're all over the zero line, but I still see the moving average below the zero line, and we need probably a good week to a week and a half to see if this uptrend is still sustainable. Here's the cumulative advanced decline line for the NASDAQ composite, and it's just pretty beat up, needs to go higher, and I would feel much more comfortable once this line gets over this little high right here. And here's the cumulative advanced decline line for the S&P 500. Now this was not beaten up as badly as I thought it would. It doesn't look that bad. And if this thing starts climbing and gets back over this high right here, I would feel much more comfortable with this market. So again, it's advancers minus decliners on a daily basis, and then we keep on adding that number up, making it cumulative. So this is the cumulative advanced decline line. Okay, what do we monitor to help predict sell-offs? We watch the advanced decline line. That's one thing we watch. And I'm just showing that one, but there's many other breadth indicators, and I watch a few others, but the advanced decline line is pretty good. We monitor the health of the indexes. So I showed pretty much all of them: S&P 500, the mid caps, the small caps, the NASDAQ composite, and then the NYSE. We watch specific support and resistance levels and the general shape of the chart. And for example, like for the SPX, we know that 2875 was a major level that we were watching. We watched the corporate debt markets, that's HYG, and we did see stress. We saw stress in the corporate debt markets, and that will impact stocks eventually if it keeps on demonstrating stress. We watched the overseas market, and as we saw, Germany was not looking good, China was not looking good. Usually we're able to see that something is brewing, but it's impossible to know exactly when it's going to hit, how deep it's going to be, and the duration. So one thing that helps us probably more than all of this is we watch our own portfolios. So we have 5 services, and we watch a good 400 or 500 stocks. When the stocks start triggering exits in our portfolios, we know something's going on. And it'll start happening 4, 5, 6, 7 days prior to a sell-off. Okay, to elaborate a little more. So what do we monitor to help predict sell-offs? We watch the stocks in our portfolios. How are they behaving, and are they triggering exits? Because we have very specific, strict exit rules that we follow. And so, for example, within the small cap momentum, the sector rotation, and the contrarian strategies, our exit triggers started 1 week prior to the sell-off. And that gave us information literally from hour to hour and day to day. We're like, whoa, okay, something's coming. We have no choice. Our exits are being triggered. We need to get out. And for these, we can actually still book profits or book small profits. We're not going to book huge profits, but if the market's selling off, we can still get out pretty fast and even book small profits on them. So for example, we went from 75% invested to 15% invested in 5 days. And that was giving us insight into what this market's probably going to do in very short order. And it did. It sold off really hard. So we follow strict exit rules. And just one last little sales pitch, and then I'll move on to the next slide here, is that we watch the best stocks in the strongest sectors. And there are always stocks that are moving higher. Not necessarily last week, and 2 weeks ago when the market was truly selling off, nothing is going to be climbing, hardly anything. But the best stocks don't go down that far. They'll only go down 3%, 5%. They'll hold at the 50-day line, for example, or just below it. And then when the market starts recovering or stabilizing, that's when these best stocks in the strongest sectors start climbing pretty rapidly. And those are the ones that we focus on. So the key is you just have to know how to find them. And we have an internal proprietary 4-level scanner that helps us find those trending stocks. So there are always stocks that are moving higher. You just have to know how to find them. Okay, where's the market going next? Well, let's look at the charts again. Actually, let's look at a few other charts. I want to look at some sectors, not many, just 4 sectors here. So for XLF, this is the financials, and this doesn't look that good at all. It's a lower high, downward sloping line, lower low, and this is concerning. So we have to watch the financials. Usually, like the banks and the financials, they do better when the economy is expanding, when loan growth is expanding, when the yield curve is at least upward sloping a little bit. Overall, people just feel like they want to be out of the financials. Industrials doesn't look that great. It's starting to rebound a little bit, but it kind of took out a lower, well, kind of a double top here. That's not that bad. But of course, we just took out a very low low here, a lower low. Transports, same thing, double top, lower low. At least it found support around November and November 2017 low here. We'll see how it recovers. And technology. Now this one looks pretty good. Not bad at all. Came down, overshot the 200 a little bit, the 200-day moving average. It's finding support around the 200-day line. And if technology is leading, it will help the market recover and help make the market grind higher. So this is actually the best thing that I see out of most of the ETFs. XLK is a broad index of a lot of technology stocks. So this looks pretty good. So I wouldn't be surprised if we'll continue to bounce back. And once we get through the midterm elections next week, and then we'll see how the market reacts. With regards to economic data, everything looks pretty good. So initial unemployment, new claims, it still continues to go lower. Retail sales continues to grind higher. Non-defense capital goods orders. This is what companies usually buy when they're buying equipment. It looks pretty good. This is year over year, so it's still in growth territory. GDP, we're kind of at 3% GDP or more or higher for the US economy. That's pretty good. ISM index represents overall manufacturing. It's still above 50, which is break even. So that means manufacturing still continues to grow. Earnings have been off the chart strong. So this is about $173 worth of S&P 500 forward 4-quarter earnings, and it continues to climb. This is ultimately what drives stock prices right here. When companies can grow earnings, their stock price will go higher. So that looks pretty good. Overall consumer sentiment looks very strong. Housing, we got some concerns with housing, but it's still upward sloping. And it's going to be choppy. It's not going to be perfect. We're just not building enough affordable housing. And that is one of the problems. And another problem is tariffs, because the costs of buying the wood and materials to build homes is getting more expensive, and that's really creating some problems for this industry. This is something we do have to watch for housing. Core inflation, we're around 2% year over year, and that's what the Fed wants. That's pretty good. Personal income and spending, this is pretty good. This is based on how much income is coming into people's pockets, and then how much are they spending. And year over year, the growth is still in the 5% range, and that's pretty strong. Light vehicle sales of trucks and cars, we're still selling about 17 million vehicles a year, and that's really good. So what it means is people feel comfortable still to buy vehicles, big purchase item vehicles, and that tells you that people are working and they have money in their pockets. Consumer credit through credit cards and revolving and non-revolving loans, the more credits floating around, the more money people will spend, and that still looks good. All right, last slide on this, and then I think I'm finished. Unemployment rate continues to drop. That looks good. Hourly earnings are climbing, so people are making more money when they are working. Non-farm payrolls have been very strong, about 150,000 jobs monthly for a long time. Unemployment has been dropping to an all-time low. We're down to around 3.9%, so that's very excellent. And that is it on the economic data. So summarizing what I see, we probably saw the bottom. Here's the SPX again, and this needs to get over that 200-day line. Still not there. So need to be cautious until the SPX gets back over the 200-day line around 2760. And if you can just stay over that 200-day line for a week to 2 weeks, then we're probably in the clear. Economy is still strong. Jobs growth, income growth, manufacturing, fiscal stimulus still is juicing the economy. Corporate earnings look great. Consumer spending looks good. Stocks are fairly priced at 15.8 times earnings. The SPX could break out to new highs in January or February, maybe in December, but I'll tell you, with this technical damage, I just don't see the SPX getting above 2875 until late December, January, if ever. But if it does break above it and then starts trying to take out new highs, I wouldn't be surprised either. SPX will probably trade range bound between 2760, 200-day line, and 2875 through December or January. The Fed will continue to tighten because they are doing their job by raising short-term interest rates. The long interest rates, the 10 and the 30-year treasuries, they will continue to move higher also, and this is expected for growing economies. Okay, that wraps up my biweekly market update. If you have any questions, please, you can call us at 877-248-7455, or you can go to our website, monthlycashthroughoptions.com. Thank you very much for your time.